Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today we have a very unique guest, Chris Long, founder and CEO of Longyards Storage, a customizable industrial storage investing firm. He's going to explain his unique strategy later in the podcast. Chris, welcome to the show.
Excited to be here. Thanks, Weston.
Of course. Yeah, so Chris, tell us a little bit about your background and how you got into this kind of niche investing space that you saw this kind of opportunity to get outsized returns for investors.
Yeah, so my story is a little bit humbling, I guess. I was just a builder, and there was a problem in the marketplace that no one was solving, and I was like, I'm going to solve this. So as a contractor, I had tools, equipment, trailers, couldn't find a spot for it. I was like, how come I can't just get a small to medium secure yard and, month to month without a 3, 5, 10-year lease and all these different add-ons? I just need that, and that's what I built. So now we're expanding internationally with great partners, whether or not it's a partner on a unit economic level or an investor, and that's how we're solving the problem and making it an international business.
Awesome. Yeah, and you're based in Florida, correct?
Yeah. So some people get the Canadian accent right away. I've been immigrating to the
Yeah.
U.S. I am Canadian, but I've been here about 3.5 years. So I'm in
Is that
Tampa.
where you do most of your deals?
Well, Florida's a tough market for iOS. Anyone in that space will kind of recognize that. Not to say we can't, but we're doing deals everywhere. We have data. We've done a lot of R&D to like where's the best place to do a deal. So I'm not hype. We are. I like to drive to the location, but at the same time, the numbers talk, and we go to where the deals and the opportunities are.
Yeah, I mean, before we get into example deals, and I'm sure you're going to go into the types of returns and benefits for investors, where do you, I mean, because you invest outside of your market, I mean, how did you start investing and give us examples of the first couple deals you did in the space?
Right. So the first example really put us on the map. I mean, we bought the land for 470,000 through creative financing. And we did a seller take back, and then we bootstrapped it. Just being resourceful, and my construction experience allows me that knowledge to do that. And we're vertically integrated, so we do the construction, acquisition, lease up, management, everything else. And that with around 1.1 million total with the land acquisition and the build out, that became worth 3.6 million, and now it's worth easily 4.5 to 5 million, and it brings in around $40,000 a month. So, and what's crazy is that in Canada you can't get many financing options. One of the reasons I went to the States, Longyards is approved by SBA. So now with that exact scenario, we only would have required $110,000 down to create a
That's
$2.4 million
crazy.
dollar return, which is a very nice return. So that was our first example. And then we just went to where the options are plenty and the financing is more favorable, hence being in the US and, getting approved by SBA.
Yeah, so you're going into the numbers here. I mean, briefly explain the investment strategy, like the overview for the investor who doesn't understand what long yards is. I mean, maybe they've understood, self-storage before, but this is a unique kind of play in that space.
Right. So any listeners that you trying to unpack it, like what is long hair? So basically like we're self-storage for industrial outside storage. So a lot of people are calling it iOS. We're very niche. We're new to the market. And iOS has a big problem. Still, even though it's new, it's hot. iOS is like 1 acre and above, 1, 3, 5 acres, 3, 5, 10 years. We are between that. We are smaller yards, shorter term. We take the self-storage concept and we bring it to iOS. And that's what we do. Now, how we're doing it is we take a partner and we, bring in SBA and we just partner. We do a joint venture. Now we are pursuing investment opportunities through like a fund. That's a little bit later. We're not there yet, but we also have investors that are actually buying into our company. And we just did a round at a valuation and through safe agreements. So people kind of got in early. Now we closed that round, but we are opening it up in probably another 5 to 9 months. And we're going to do another safe round because we have a lot of territory to cover and we have a big vision. So a little bit about the investment and how we're doing things.
Awesome. Yeah, and a lot of investors look at track record when they're investing with an operator. That's one of the first things they look at. So give us a brief overview of your track record and some sample deals.
Right. So the first one was in Ottawa, Canada. The second one, we actually have two more grand openings in the next about 6 weeks at two of our next locations. So, the one of them took a long time. So this was in Central Florida because of zoning, setbacks, just stuff that's out of everyone's control. And then that took a longer time. But our next location after that, I mean, we're grand opening by the time we took possession, 3 months. And we have a good vertical integration of construction. It's not, super simple, but it's definitely quicker compared to most, ground up developments. So, and then we also have two more under construction in the next 3 months. And I'm also a builder. I'm a licensed carpenter as a general contractor for 15 years. So this is my bread and butter. This is what I do. And, a little bit about my track record. And the first one was a big hit, and now we're just doing it over and over again.
Yeah, so you said you construct these long yards in 3 months. Is that correct?
Yeah, we're actually working on dialing that time down. But yeah, with everything, and that's only 3 months because there's warehousing improvements. But if it's just like land, that what we call tier one, like ready to go, it could be even quicker.
Yeah, I mean, that makes sense because you're not constructing a building. Because
Right.
most buildings take, I look at development projects, it's mostly 3 to 4 years. It's crazy.
Yeah.
And
Yeah.
so you're basically reaching cash flow in month four. I'm assuming you start to lease up, and that's a whole process there.
Right.
I mean, once you get it built, say 3 months after investment, which is much sooner than the usual time horizon. I mean, how long does the lease up take?
Yeah, great question. So yeah, like we're quick to market, we're quick to build, and quick to cash flow with low risk and low capital expenditure. So that alone, just to emphasize, like we're doing what most people do in a more compressed time with a higher return, right? Because we squeeze so much value bringing the business on top of the real estate. And the lease up really depends on the area. There's so many metrics, right? As an example, do you have a 3 acre site in the middle of downtown, or do you have a 10 acre site that's 20 minutes on the outside? So it really varies the lease up on the market. But what we're doing now with everything we're learning is we're pre-marketing and pre-leasing before we even go into markets. So we have a wait list and we can just hit the ground running. But to answer your question, it's so market specific that we have like a projection with our underwriting tools, and then you gotta go to your saturation and actually really lease up to challenge your assumptions. So we're still a little new to give the exact, but it's hard, right? Like you heard my answer, and it varies where we are, and it's just so site specific. But we lease up
Sure.
quick. I will say
Yeah,
that.
and you mentioned the fund model, and I'm assuming you raised previously for each individual deal. I mean, where do investors come into play on these deals? Are they debt partners? Are they equity? You're getting high returns on these projects. So are they equity partners then?
Well, right now, yeah, it's an equity partner and it's a joint venture. So that's how we're doing it. Really simple. One unit economic, one person, one deal, just me and one other investor per location. Really simple, really clean. In the future, though, we will be taking in outside investors, and that will probably be more of a debt structure, just a simple return profile, probably with some upside potential. We're not pursuing that right now because we're just laser focused with that structure, but a lot of investors are happy, and they just want to keep doing more deals actually. So we have no shortage right now. It's a good problem.
I bet. Yeah, so one investor per deal. Do they have control rights in that?
So they have control rights on the larger things, like to sell. It has to be shared with the decision between both of us with partners to sell and the operations. But at the end of the day, we have a brand manual, we have a licensing agreement. They need to understand that they're following our blueprint. We know what we're doing for a reason. We're good at what we're doing. They have to get into understanding that. But at the end of the day, we take the steering wheel, we drive the ship. But on big decisions, yeah, it's we got to decide together.
Yeah, how much do they usually bring in? Obviously, it depends on the site and the size of it. But you have the SBA loan, which you can use for high leverage. What do they usually bring in per deal?
Yeah, so this is a great example. There's one location we're doing is in Jacksonville right now. Great market for Longyards, and I mean this is a lease, and we negotiate leases with purchase options, right? So there's so many different ways for us to do it. And this one, the build out, it's like 500 grand. So SBA is $50,000. Like the loan is 50 grand. And this is like small, and this is a net profit of over $10,000 a month. In fact, it's much higher. I'm just saying that to be conservative. But that's what we're looking at for a deal that size. Now, on a purchase, so that's just like raw cash flow, right? That's 10-year lease. But on a purchase, comes you might be anywhere from 150 to $250,000, which by the way, we put 50% of the money in, and it's a 60-40 split. 60 to the investor, they get an extra 10% for signing. and then we get 40, but we put 50% of the money in. And we do that because we do the construction and we take our profits and we put it back in, right? So there's so much value being created and because of our skill sets, but that kind of gives an idea of the size, opportunity size. We don't need to be a full development company. Our mission is to create affordable yards in marketplaces, in top marketplaces for small businesses, and we do that through leasing and purchasing real estate. But we're not a full-blown developer. Frankly, I don't want to be, and we don't need to be to solve the problem. But we can all make great returns with our creative solutions that we bring to the marketplace for
Sure.
investors.
Yeah, and I'm in multifamily, and obviously it's very competitive. And so being in these niche strategies, I mean, I've seen people get much higher returns than a niche that's saturated. Um, so why don't you put your own money in? Obviously, you do. You said you put 50% in, but you're doing a lot of these projects. I guess they don't require a ton of capital for these projects. So I mean, what's stopping you from controlling the entire asset?
Well, that depends. Again, like on a small lease, it's still $500,000. What's easier, five hundred
Got it.
thousand dollars or $50,000, right? And I don't have a green card, so I can't even use SBA myself. It's because I'm Canadian. So then we're like, how do we solve this problem using the highest loan to value? Well, that's SBA with partners. And how do we do it? Keeping our life simple, one partner, one location. So it's easier for me to come up with 25 grand and get 40% than it is to come up with 500 grand and get 100%.
For sure. Yeah, and what's the waterfall with that one partner?
Simple. It's just a 60/40 all the way through. Whatever happens, refinance, cash flow, very clean.
Yeah, is there a pref in there?
No pref. It's
No
more of a business,
pref.
more of a joint venture.
Wow, that's incredible. How many of these deals have you done?
Like we just started pivoting to this. I'm a franchisor. We had franchising and it was $50,000 for a territory, 7% royalty. Then we switched to the joint venture model because the deals so far and few between that we wanted to get more of the pie on each location than less pie from what we thought there was plenty of them. So we're still a little bit new to doing it this way, and by the time a life cycle comes from partner finding location, due diligence, it's sometimes a year to year and a half. So yeah, that's why I got two grand openings in the next 6 weeks. But it's been about a year now. But we got two more construction events happening in the next 2 months. So it's still new, and with the lead time, there's a life cycle behind it.
Sure. Yeah, and what markets are you primarily investing in?
Yeah, I keep that one hush hush because we have our
Really?
TAM. We've done a lot of R&D. We've been doing this for 5 years. We know the top markets where the price makes the highest return, and that's something that partners get access to.
Sure. Yeah, and how do you spot these sites to build your long yards? What's the criteria that you look for? Obviously, you're, a few acres of, you have a gate, you have to build a fence around it, and customizable sites for these, or customizable yards for these industrial companies. So what do you look for when you are, I guess, building out the site?
Right. So we have a funnel, right? At the top of the funnel, it starts with what are called our TAM, our total available marketplace or adjustable marketplace, some people call it. And that's like, where can we even do a long yards, right? And then it goes to zoning, and then it goes to local building requirements, and then it goes to our buy box, and then it goes to our feasibility tool. So it has to go through all five filters of this funnel to then be required, then be deemed feasible by our internal process. So, there's a few high level things. You want a population of a minimum 50,000 people. You want what we call tier one. We don't want a forest. We don't want to go through 2 years of development to put up a yard. That's not what we're trying to do. We're trying to solve problems quickly and move quickly so we can get a return quickly. So we're very focused on that. But yeah, and we can go through each one by one, but there is a filter process that we've learned through many times, trial and errors, and we've got it really dialed in now that we don't even waste our time on something that doesn't even meet our buy box and our feasibility.
Sure. Yeah, so you're doing the joint venture model, and you mentioned the fund as well. So when do you plan on moving to the fund model, and what should investors expect from that?
We haven't, I'd be speaking too prematurely if I had detailed answers on that because, I have some ideas. Like we're looking probably for just a debt return of an interest rate that's attractive to the marketplace, probably a little more on the upside because we're so cash flow intensive, and being a little bit of a new model, even though we are some of the safest business by being self storage and real estate, we are generally pretty safe with a low failure rate, just in terms of market, comparisons and business asset classes.
Yeah, and margins as well.
Yeah, high margins.
Some other real estate asset classes are not good margins,
Yeah.
especially now with these expenses.
Right. So, I don't have it completely defined because honestly, we just have so many investors coming to us right now that with the joint venture model, it's very clean. But we do want to pursue that fund in the future, and it might be sooner rather than later, but it's not. If an investor really loves what we're doing, then they can invest directly in the company, which is like a short window of time. But besides that, the fund is still a little premature to talk with definitions.
Yeah, you have a lot of investors coming to you, so I mean, you probably can't take them on for projects. If they're investing in the company, what are they actually investing in, and what should they expect?
Right. So, I mean, they're expecting a 2 to 3x return within. Now, I say expect. I do have to be careful with my choice of words. It is a safe agreement, so it's a secure agreement for future equity, and safes have risks with it. Most investors have probably recognized that. But what we're projecting and what we've seen, I mean, we just raised at a $12.5 million valuation, and that was where we were at a while ago. And with everything else we have going on, we're already exceeded that and are exceeding our original projections with our original investors. And they were looking at probably I'd say a reasonable 2x return within a year's time, probably 12 to 18 months, roughly. So, they got in that early, they got a discount. We are planning another safe round, like I said, probably 5 to 9 months window roughly. But it's not just the Longyards play. There's a whole ecosystem at play. We're completely vertically integrated for control and operations. So they pretty much get wrapped up in a blanket with everything we're doing. And when they come into our, let's say, inner circle, starting a dialogue, they start to see more. Like on the surface of the iceberg, it's like you see what we're doing at storage yards, but there's so much beneath with data, R&D, and what we're learning to seek other opportunities. It's really a massive opportunity. Yeah.
Sure. Yeah, and you say a massive opportunity. Is that kind of building out the size of the company?
Yeah, well, I mean,
How many of these deals are out there?
there's a lot, man. We have thousands in our TAM that can work. That we've been very selective with our R&D, and we have off-market, acquisition strategies. So like, if you kind of like zoom out, iOS just in the United States, when I say iOS, industrial outside services, $200 billion industry. All right. Now I know some people are like, oh yeah, that sounds great. Nobody is doing what we're doing, how we're doing it. All right. Everyone, you got Zenith and Altera. They just raised, multi 6-figure, 9-figure $1 million funds to go after iOS, and they're not even doing the cash flow play. They're just doing a compressed cap rate exit play.
Hmm.
We are going after the market between,
Yeah,
right?
they're
So
doing like a roll up.
they're doing a roll up. So think about
Yeah,
who got into self storage before it became self storage, and who got into iOS before it became iOS. We're doing storage yards, which people don't even know is storage yards, and we are after a massive market, and we're laser focused on how we do it. And that's just US. We have the formula to go everywhere, and we have other solutions to solve the problem that are beyond what we're even talking about. So yeah, when investors start hearing about that, they get excited.
so yeah, what's the constraint?
Definitely land acquisition is the constraint. Capital partners is the constraint. So it goes to acquisitions and good partners. But it's also what we're finding is the third constraint is just frankly capacity from a human capital from our team. Now we just brought in those funds, so then we're just building out our team to then break through that bottleneck of growth, so then we can have more capacity for acquisitions and partners because we have so many partners right now that we need to beef up our team to then support more acquisitions.
Got it. Yeah, so it seems like you have enough investors, and you have the projects as well, like the target acquisitions. It's just managing the construction on those, correct?
Right, and because we have a patent pending product with our fencing that's very modular in design, it's very unique to the marketplace, and we're very innovative with technology as well. So we're keeping things in a moat of how we build our business that's very protected and unique to the marketplace. So it takes us a level of control to not go too big too fast and to really be methodical. So right now our thought process is go slow, go proper, build the right team, right infrastructure, and then go far and fast.
Yeah, build that foundation first. You mentioned the larger private equity play with the multi nine figure fund with the roll up strategy. Is that something you plan on doing down the road?
We have so many different opportunities and ways to do things. It's somewhat playful, and it's good and bad because you can get carried away with distractions. And one of my biggest things is to say no, to be focused. Now, it's interesting because like there's pros and cons to that. They have to work with how the investors tell them they want to work. Now, the way we're building Longyards is to maintain control. So I don't have any whale at one time telling me what to do ever. And frankly, I don't want to ever have to deal with that. So if maybe I'm preemptively speaking a little bit, but as some of these guys, they have these massive investor partners, but they're a puppet on a string. And no offense, that ain't going to be me. So we have control of how we do things because at the end of the day, what's best for investors and private equity is not always what's best for the business and for the avatar of a client, right? They're trying to squeeze how much profit they can make, and there's always a balance and a sweet spot between a good founder, I believe, and what's good for the business and what's good for the investor. So if a lot of these big whales come along and say, look, this is our way or no way, it's just going to be no. So to answer your question, I'm open to it, but it would just have to be very aligned with our core values and our mission as a business.
Got it. Yeah. Do you have any partners or co-GPs that come along in your deals?
Right now, well, besides the joint venture, which is one and one, that's it. Besides that, I'm the founder and sole decision maker.
You're the sole guy. Um, and for someone that's listening to this podcast, potential partner or investor, I mean, what are you looking for right now, and how can someone look to possibly collaborate with you if they like this strategy?
Right. So right now, our avatar is more for the high net worth individual, whether it be a doctor, lawyer, engineer, or you have a business, even a construction business, and you think you could bring value to us with what we're doing and how it provides value to the marketplace, plus being an investor. That's really ideal for us. So that's what we're looking for. Someone that also has the contacts or could sign on the SBA debt. SBA does have a ceiling, so usually it's around $5 million per person. So we do reach a cap, but that's pretty much high net worth individual that understands commercial real estate enough to want partake in the opportunity. But it's also an education process. You're not just coming in blind. We show you exactly how we underwrite, why we find the deals, what is a deal, so you have great confidence in exactly what we're doing, and that's what we want. We want more of a partner that sees the vision and wants to help with the vision, not just what's my return profile.
Sure. Yeah, and if a partner is interested in reaching out to you, how can they reach you guys?
Yeah, longyards.com. You just fill out a form and it'll get sent to us, and go from there.
Longyards.com. Easy.
Yeah,
Easy
easy.
domain.
Got it.
Awesome. Thanks for coming on, Chris. Really
Thanks,
appreciate it.
Justin. Yeah, I appreciate that.